Mr. Chris Frostad, how are you, sir?
Sir Matt Gordon, very well, thank you.
I'm glad to hear it, Chris. You're sort of slowly being buried alive with snow in that part of the world, aren't you?
Yes, it's Toronto. For some reason, it's the biggest storm we've had in a long time. I've spent the last couple of days just digging out the cars, the children, anything else that happens to get stuck in the snowbank around here. It's been feet of snow. It's crazy.
That's good. Well, we're heading there, 2 weeks' time, is it? Must be 2 weeks for PDAC.
That's right. Yeah, we're hoping to get rid of it, most of it by then, but we'll see.
Man, I hope so. I haven't got clothes for that kind of weather. That was just crazy. You're a tough lot, hardy lot, the Canadians.
That's it. We got more boots and coats and things to handle all the different seasons than you can imagine.
Right. Okay. My wife would be jealous. Right. We are going to get on to all things. Look, it's a happy family day, by the way.
Thank you.
In Canada land. Hope you're having a lovely time. We don't have as many holidays as you guys. So you obviously need it. Is that it?
Yeah.
Yeah. It's tough being Canadian.
It's a good thing it's a holiday today and people aren't out on the road. It's
really bad. It's that bad. Well, we better go and talk all things uranium. So I guess there's a lot going on out there at the moment. I think we're going to talk today. We'll tell you what we're going to talk about in a minute. But there's obviously a few things happening out there, like conversations of it's kind of very 1980s, isn't it? Where we're talking. Mr. Trump was talking to Russia and China about maybe de-escalating and getting rid of the nukes, and people are a little bit concerned about what that means in terms of recycled warheads flooding the market.
Yeah,
I buy that?
Yeah, no, I don't buy any of that. I think you have to take Russia with a grain of salt, Mr. Putin in particular. I'm sure people of Ukraine are cowering right now, wondering what sort of nonsense the two of them are figuring out how to divvy up. So I don't know. It's we in Canada have kind of stopped taking this stuff overly to heart. We're just hurt. So we'll keep watching and we'll react as we need to. But in the meantime, it's a lot of noise and a lot of theater from up here for sure.
Right. Okay. Well, that answers that one. I think people have done whole 1 hour programs on that.
Oh,
there we go. There's the 1 minute version, folks. Which we'll see where all that goes. Any other things people are worried about? I'd say not much happening with the stock market, or quite frankly, spot at the moment. There seems to be a constant conversation.
No, I think the markets are doing as we would have expected, but up here we really are just trying to brace ourselves for whatever tariffs and things Mr. Trump decides to inflict on us and the rest of the world.
Right
now, and yeah, that really is the focus. I mean, we're going through an election year as well, so we're going to be coming up with a new liberal leader and a new prime minister, and it's interesting because the entire focus of evaluating any of these individuals is how they're going to stand up against the U.S. So that's certainly changed the conversation up here.
And who's the favorite?
Right now, Mr. Carney seems to be taking over for Mr. Trudeau. He headed up the Bank of Canada here for years and the Bank of England for quite a while. So now he's back in Canada, and it looks like he will be our new Liberal leader, and we'll see if he goes up, how he does against Mr. Poilievre, who on the Conservative side, who is... he's going to be new to this, so he's a bit of an unknown, and he's had to change his tact. His tact to date has been just deriding the Liberals and Trudeau, and now all of a sudden nobody cares about that as much as they care about what are we going to do about the U.S. And what's interesting is that there isn't a politician within any party that isn't expounding the same tactics towards the U.S. So everybody's in violent agreement, which makes it even more difficult to differentiate yourself as a politician looking to be elected.
I mean, that's obviously going to have a big impact on one of your big one of your big exports, which is your natural resource that I'm fitting.
Yeah.
Oil, gas, and all these minerals that you've got. I mean, they don't necessarily all need to head south to the US. They can go anywhere, but it seems more convenient if you kind of did a deal with Trump. Mm-hmm. And the U.S., wouldn't it?
Oh yeah, well yeah, any of the critical minerals. So it's there's a lot of blowback, and we are the largest importer in or exporter with half of their states. I mean, it's. I think we've all kind of backed up and said, you know what, it's not really about the tariffs as much as the trade, as much as a negotiating tactic of other things that the U.S. wants to see from us around the borders, around around security. I mean, there's got a lot of things in the air, and I think the U.S. and Mr. Trump in particular are throwing up so much dust right now. We're all waiting to see how much of it actually lands, and what the reality is. They've turned the tariffs to Canada on and then off, and then they put another tariff back on, and now they're going after everybody tariff wise. So his approach towards tariffs is yet to be seen how economically that works out for everybody, because the U.S. hasn't. There's as much pain going to be suffered within the ranks of the U.S. as in the countries that they're imposing tariffs on, because they pay the tariffs initially. So it's how does it?
Well, it's certainly initially. I mean, there's lots of conversation going on here in Europe around the same sorts of things. We've got the added bonus of high energy costs here in the UK as well, which affects absolutely everything. Even if you could get to the root cause of the political aspect, I guess energy is political. Initially, hard costs for the consumers like us. Mm-hmm. But eventually, I guess the hope is that it's more things are made in America, and that's a key driver. Whether that converts quickly enough, it's another matter, right?
Maybe the answer is you got to break a bunch of stuff because you really can't get there from here, or it'll take too long to get there from here. Yeah. So break it and put it back together, right? And that's a tactic too. So
men better than us can't work it out. So we shall see. Is the oft refrain that we go with. But look, let's go back to things we do understand, which is a little bit more, which is the world of uranium. There's still a few mysteries. Today, I think we're going to talk about a few things, but the sort of headline is basically how to spot the best uranium juniors before the rest of the market catches on. Okay, and you can probably apply some of the things we talk about today to other commodities, other metals as well. But because it's really about kind of the psychology of commodity cycles. So we're going to talk about commodity cycles. We're going to talk about where the uranium cycle is now. We're going to talk about how to identify some of those juniors. We're going to require the sort of mindset you need to have to be able to play in that space. And obviously, at the end of the day, you've got to make some money, and you can only do that if you exit your trade, ideally at a profit. So that's where we're going to go today. So why don't we start with, in case there's some younger people or less experienced people, let's just understand, what is a commodity cycle in your mind?
Well, it's the rebalancing of supply and demand, I guess, is to obviously when supply is low and demand is high, your prices are going to go up, and particularly in the mining industry, because the time lags are so great. By the time your supply, you start cranking things up and your supply keeps going up. If your demand stays constant, you typically overshoot it and you wind up heading in the other direction. You've got oversupply and under demand. So it's these ups and downs in the cycle of trying to figure out where you are in those cycles and how you should be investing in those cycles. And I think what we see is a lot of boom and bust mentality. Investors are chasing highs, and they're panicking during lows, and it's really knowing where we are right now in the uranium cycle. And I would say we're kind of mid cycle, whereas a lot of folks out there who are only watching the spot price would think we're through the cycle. We're heading down into a down cycle, and I don't think that's the case at all. So it's how do you back up from this and really understand where you are and avoid the panic and the herd mentality and the hype to be getting in and out of this stuff at the wrong time.
Right. Okay. So, I mean, I read a report, I think it was JP Morgan a while ago. It sort of measured what the average retail investor makes. And it was a sort of 20-year study, right? And I think they got to the magic number of the most retail investors will return. It's positive, so that's good. 2%. 2% a year over a 20-year period. So not much better than I think the average banking interest rates over the same period. So without all the stress is the reality. So we've got to think of better strategies when we're investing if we are to do better on average. And unfortunately, on average, probably not a very good way of measuring these things. But we the smart people listening and watching this, the cleverer retail investors, what is it that we're all looking for? What is it all that perhaps we should be looking for to consistently maybe understand the commodity cycles and consistently, place the bets in the right place. So, I mean, tell me what you think. Do you were surprised by that number?
No, it doesn't surprise me at all. Well, 2% seems a little low, but probably not, because if that's the average, that means there's been a lot of losses on top of a lot of gains, right? A lot of negatives there. But it really does. I think it points to why a lot of people are getting into ETFs, because they just don't have the time to really put in the mindset or the mind time to understand all of the things you want that other people are spending days and days and weeks and months on understanding. So how do you, so yeah, there are going to be a lot of mistakes made, and you hear it every day. People jumping on a bandwagon, but they're jumping in too late, or they're getting out they're getting out after the fact when they should have gotten out earlier, or they're mistiming the markets. They're mistiming or misinterpreting actually what is happening out there right now. Because I think, what we've seen in the last year or two is simply a correction mid-cycle, which makes sense. We would have kind of expected to see that. But not recognizing it as such is going to change your behavior, and you're going to make all the wrong decisions.
Right. So cycles more broadly. Let's just try to kind of bring it back to basics initially, and then we'll kind of wing it out to the world of uranium specifically. So, in terms of cycles, we're talking about things like economic growth. So understanding or having a view on what the global economies in plural are doing. Certainly the big metal consuming ones or energy consuming ones. The China's, India's, Europe's, North America's, etc. Supply constraints, which I think, for most metals and uranium specifically, that's got a very big driver is the kind of supply issues which are coming down the line relative to demand. So, and how long those things take in terms of, we talk in oil and gas terms, they're talking about maybe a year. In mining, it's 10, 15, it's 20 years. So it's a real, to get that kind of supply element back in focus is a long time coming. Obviously the usual inflation, currency trends, etc. So, I think metal is sometimes seen as an inflation hedge. Whatever the US dollar is doing, whatever the US politics is doing, we've talked about already. We've got technological, industrial demand for all of these metals. Do we understand enough about it, or is it fairly opaque? I would put uranium in the opaque, slightly hard to read side of that equation, as I would with copper, probably lithium, nickel, etc. Your cobalt in it, cobalt, lithium, nickel, and then the kind of geopolitical stuff which we speak about most every time we speak. We're talking about trade policies and even kind of like environmental or geopolitical factors. And right now there's a lot of geopolitical factors in uranium. So there's a lot going on when you're trying to understand the cycle. And I think I would advise most people, try and understand the backdrop and the macro and the cycle before you start committing dollars specifically to any one group, one company, or even kind of group of companies. And you hit the nail on the head. I think ETFs is probably where most retailers should play. If you don't have the time or the experience or the courage or whatever, that's where you need to be playing. I know you always tell me off for saying that, but it's true. So there we go. Cycles, in my view, it's you gotta make the time. If you haven't got the time, make it someone else's problem or responsibility, right?
There you go.
You got nothing to say. There you go. Sorry, I'm rabbiting on. It's better than ranting, but I'm rabbiting on. So, what else? What else do you think you need to when you talk about this kind of lack of ability to consistently? What are you talking about?
You do need, and I mean, you brought up a few things in terms of the timing of these cycles and how long they take. And certainly in mining, if we're talking about that rebalancing of supply and demand, you can't it doesn't happen in a year. It can't at all happen in a year. And, where we saw the spot price move over 2 years, the last 2 years from $40 up to, whatever, 100 and some odd dollars, you really got to scratch your head and say, okay, what am I looking at? Is this really, something I should be jumping onto, and when should I be jumping onto it? Because of course it immediately came back off, and what was causing that rise in the spot. So I think you have to recognize whether it is a cycle or whether it's being driven by something else. Is it really a macro thing happening here? And what is happening on the macro basis, or am I witnessing some other factors that are in particular driving this behavior, and will it last? Because that's what we've seen in uranium, is that it moves quickly when it does move, and the price up and down, and is that what you want to be chasing, or can you afford to chase it? Because I think uranium at one point was thought to be a quick hit investment if you went back a few years, and then I'll get out. But now the demand, certainly, the long-term demand and the underlying thesis for it is more of a longer-term play. It's going to continuously, in a lot of people's minds, just keep getting tighter and tighter and better and better. So you got to quit reacting, or to the short-term bumps and jumps, and really understand whether this is part of the cycle or not.
So what are you advocating now? Are we saying, look, you need to, timing's crucial? However, perhaps you need a longer, more contrarian mindset. I mean, is there a right answer?
Well, there's a bunch of right answers. So, I mean, yes, you have to understand where you are in the cycle, where you think you are in the cycle. And again, as I think we're mid-cycle. And if you look at the long-term price of uranium if you look at the long-term price and the spot price, you're still only looking at about 40% of what's going on out there, because most of it is not visible to us mere mortals. But what you would see is that the squeezing that we talk about in price, internationally, and all these things that are going to affect it, are in fact affecting the long-term price of uranium, and it's going up and up and up, and that squeeze is going to continue. We're still looking at, utilities still haven't been contracting to the levels they should be. The last go around back in the 2000s, they didn't really start, actively recontracting up until it hit about $80. So, and with all the uncertainty that's going on right now, it's not surprising that they're waiting for things to stabilize before they really jump in. So, as far as where we are in the cycle, I think we're mid-cycle, and I think what we saw happen with the spot price and the way people reacted to that was just a mid-cycle consolidation, and people reacted inappropriately to it. So as things started taking off, people started buying near the top. We saw equities running up at the end of 2023, along with the spot price, and and then when the spot price started to back off again, everybody jumped out. And if you were buying on the way up and jumping out on the way down, you probably lost money. But if you just stayed your course where you were at the beginning of 2023, were buying before, and saw that cycle coming, a normal cycle, you would have just ridden through it. Normally you'd probably still be up. So it's that again, it's that herd mentality, it's that fear of missing out that drives retail buyers to make bad decisions at the wrong time. And so as far as cycles go, I think, we're going to continue to see a squeezing of uranium prices, uranium supply, and it's going to continue to manifest itself in an upward direction, as we think it will. And so you should be investing based on that assumption, not on what the spot price did last week, or what, happened, on a mine in Kazakhstan, last week, because the utilities are not day trading uranium, based on today's news. And a lot of people are trading equities as though they are.
I'm trying to understand what you mean by mid-cycle. right? We haven't got we've arrived at the 50% point, and then we're going to go for another 50%. It's look at that journey that we've been on from say 2000, let's say 18 through to now. I think is that a fair time frame to kind of look at where uranium sort of started to behave in a way which might be interesting, and where we've got to go. I mean, if you look at sort of a chart of the average share gain per company in that space, it's been a wild ride. It's been a wild ride for sure. If you look at spot, whatever you want to, you look at spot price. If you want to look at that, month over month, your spot price has moved meaningfully, and depending on the type of company that you invested in, some have done really, really well, and everyone's on a kind of pregnant pause, and others haven't been able to kind of catch the wave necessarily. But the general trend is up. So whether it's a small accretive growth chart or a kind of quite spiky one at various points, that's depending on which company you pick. But do you think that the second half, if I can be so crude as to simplify it like that, is going to be an equally wild ride? Or do you think that this thing has the ability to plateau for a bit? Do you think it has the ability to actually spike, quite aggressively? What's the future ride like?
Well, I think what we're looking at is, it's the long-term price. Sorry, is now sitting at around $80, which is getting up into that realm of I can turn a mine back on. That was always the issue. I mean, the price of uranium was too low to even produce uranium. We've been producing less uranium than we've been consuming for 6 years now. So we know we've got that imbalance, and we know that the contracting hasn't really taken off in earnest yet. So, all the news stories that we talk about, all the supply issues we're running into, all the demand, gains that we see happening, that squeeze is going to continue to happen. And, again, we'll probably see the spot price jump all over the place as it continues to do. As I mentioned before, in 2024, I think there was 7 trades a week. I mean, this is not a very, active market. And most of those trades were less than 100,000 pounds. So it's, and I would say because the reason for that is because there is a lot more focus on contracting now as opposed to running their businesses on the spot. So, the volumes are down on the spot, so the price is jumping around, bouncing around. But you really have to keep your eye on the long term and on the utilities. And we're continuing to see that upward trend. And I don't think the real squeeze has happened yet, because we're just now hitting, a reasonable price of uranium on a long-term basis. And that squeeze is still coming. So, you've got to watch for it. I don't think it's going to be, again, if you're watching the spot, yes, things appear to be abrupt, up and down and in and out. But if you're really following what the utilities are doing, and you're following what, in the longer term, what all these geopolitical issues mean, and where the contracting's at, you're going to see that. I think you're going to see that we're only halfway there. We've just reached a reasonable price for uranium. But now the supply is really going to get squeezed over the next year or so.
Right. So when we're talking about squeeze, we're talking about the ability for producers to supply into that demand.
That's right.
Right. And it's I think this is the bit that kind of scares me about it. Well, so it excites me as an investor, it scares me as a consumer of energy, is the people who are saying they will get into production by a certain date, 2026. 2027, 2030, go that far if you want. I don't think half of them will be able to do that. And, when I kind of look around and speak to the people I kind of respect in the industry, not just CEOs, it's quite clear that the supply as advertised is not going to be delivered. And that amplifies that squeeze somewhat. And I wonder if the utilities have factored that in. I hope they have as part of their chess game that they're playing. But if they haven't, that's a real problem. And it won't matter, as I keep saying this, it won't matter at that point whether uranium's at $500 or $1,000. If it isn't there, it's not there. It's a great incentive price to people to get going, but it's going to take them time to actually do that. It will take them,
Absolutely.
3 years.
Where are we in the cycle? So will they pay? And they probably will. Will the long-term price get up to and exceed $100. I mean, that'll be the test. And if it does, okay, are we at the peak net? I mean, again, timing your investment, it depends on where you think you're at in this cycle. So if you think the bull market's over in uranium and we're heading down, then you should be, that's the way you should be investing. But if you think we're only halfway there, you should also keep an eye on where what are the signs that it's time, that you've reached that peak and that it's time to turn it around, because you don't want to be, you want to be selling into strength too.
Okay, so let's look at that. Let's make those assumptions, because the trouble in this space is it kind of sounds like, it scans like, it reads like everyone's drinking the Kool-Aid and going, oh, the demand is this big number and we can't supply it, and and it sometimes gets a little bit trite and a little bit, oh my God, not again. People are bored of this. But because no one sees anything changing. We've bought into this thing for the last 7 years and nothing's really changing. Spot prices moved, from whatever it was, $25 when I first started re-looking at uranium again, and here we are, 80. I should be excited by that. And we've made some good gains along the way, but it's just like this pause thing. It's boring the heck out of people. And you're right, a lot of people just abandoning ship. Are you saying, given if we believe that demand story and rationale and data, which that's trouble, I don't think there's a lot of data. It just seems to be a lot of wishful thinking at the moment, not some actual data. Do you think there's no wrong time in terms of timing this? Get in now, sit back and treat it as one of your kind of long hold part of your portfolio. Is that a good mentality to have?
Well, it is. And now you have to move into the other questions. Okay, which are the right ones to be, which are the ones to get into? And that's,
so what are they? Are they the former producers? Are they the developer stories? Are they the explorers?
Yeah, I think it's a mixture of them all, right? You've got you really have to balance things out, and you have to watch who you're buying into. So, for instance, I mean, NexGen's a good story, right? I mean, back in it wasn't that long ago, not more than 10 years ago, they were a penny stock as well, and but everybody knew that they had you go back to how do you pick these companies? They had experienced management. They seemed to have some very interesting ways of finding financing that others weren't, and they'd moved their efforts from where they were over to where Fission was finding stuff. So all of a sudden, so now they've got some very interesting land packages. If you got in that before they found Arrow, within 6 months you were dealing in dollars, not cents anymore in terms of their share price. If you waited until the momentum took them off, you only made 2 or 3 times your money instead of 100 times your money. So, if you're dealing in an exploration company, you have to evaluate the right time to get in. And the right time to get in isn't after they've, after you lost all the big gains, because that's not why you took the risk, right? And if you're looking at developers, it's a different story as well. I mean, Denison was a good example of during the downtime, what they were doing was picking up other properties and financing themselves in non-dilutive ways and expanding. They were really preparing themselves for a better time more than not. And when things got hot again a couple of years ago, they saw the benefits of that. So, and then producers we know are gonna just follow the price of uranium in a different way as well. So it really is that mix. It's the mix of risk reward and what it is you're looking to get out of all of this.
So it's kind of like a blended risk portfolio is what you're looking for.
Absolutely.
In this case, the vertical is uranium. We're talking about today, but it could also as well apply to any of the kind of macro thematics that you like copper. I would advocate, and obviously gold's had a good run in 2024. I think it'll continue this year. Where in the US seems to be emptying the UK of gold bars. It's interesting, and silver making a comeback too. Obviously, with the kind of industrial usage actually deliverable. That story is actually becoming truer with solar panels. So I think a diverse approach to investing is quite good on thematics which you understand and you believe. I think that as you outline, the kind of mixture and the blended approach to exploration, development, and producer is equally sensible. But it does come back to that timing thing. Is there ever a wrong time with the right company?
Well, it depends on what category you're investing in. So again, if you're looking at exploration, and ISO is a good example of that. I mean, before they did their merger with Consolidated, back when they found Hurricane, but to look at IsoEnergy, you would have seen a company that was spun out of NexGen. So they've got reasonable management. Obviously, they know what they're doing. They're being funded heavily by NexGen, so they've got financing capability, and they were picking up slowly over a couple of years, picking up strategic projects and properties that were in the right area in the right place. So was it a surprise that they all of a sudden came upon a big discovery? No. They're I would say that they were positioned better than most at the time to do that. So, but it's looking for those ones, because there's too many out there that are, just they've picked up the scraps of whatever property they can get a hold of. They've made bad deals to get it. They've got no way of financing themselves other than issuing shares. You're really throwing darts at a board at that. So there is a way, and we've talked about all these ways of evaluating these companies to find the ones that you think are going to bring you the crazy big returns. And again, then when you look at the developers, you've got another set of criteria to look at, because you're looking at something different. And to your point, can they get to production? Can they continuously de-risk this thing, and in that way keep creating value in that asset that they're moving forward? And you have to look at a lot of the same stuff. What's their management team? What are the and you don't always have a good sense of the management team, because these aren't people you can just haul out of Fortune 500 articles. But I think you have to look at what have they been doing? Are they acting in an intelligent manner? Are they doing things that look smart? Does the company appear to be capable of really taking this thing all the way? And, yes, how are they managing, how are they financing these things? What order are they doing things? How are they spending their money? So you have to evaluate these companies in the same way as you would any commodity. But, if you believe that this market is going to keep going, and that we are only mid-cycle, and the value is going to continue to be there, then you have to find the best vehicles to ride to get you there.
So I was laughing when you were saying that. It's kind of like, you think if you're right, that you can't drag all the management out of the Fortune 500 companies, or just doesn't happen. It's kind of like your friendship groups. You probably over the course of the years, probably about 100 people you will see that are sort of in your friendship group across the year, and you think, how many of those do you actually like? Maybe 5. Yeah. It's the same with the management teams.
Yeah.
It's like
they always borrow money from that guy, and it's good for a laugh every once in a while.
Yeah. I have had people.
But as well, we see. Yeah. We read the news on all these companies. Every once in a while, you see a deal they've done, and you just kind of wince. You go, what?
Yeah.
Hell. Yeah. You just know that you're looking at some. They really didn't know what they were up to. They didn't have something going on, because they just got taken. And again, it's the way they finance the companies. It's the way that they're doing their work. It's read the way they put out their press releases. It's do they sound smart? I mean, a lot of these. Yeah. We've seen some crazy things come out as disclosures, and they get pulled back by the exchange and told to redo it, and you can if you're paying attention, you can see, you can get a better sense. Sorry, as to
exactly. No, look, ultimately it comes down to everyone who knows anything about the space. It's 100% about the management team, and all the cliches come out about good management teams, what they can do with a bad asset, and bad management teams to do with a good asset, all that sort of stuff. But unfortunately, it's true. I think the thing for me that kind of really kind of just stuck with me, and I've had this conversation a few times with different CEOs, a different cycle, parts of the cycle. And I was on with Duncan Craig a few weeks ago, where think it was a bit on screen, and he gave me a bit more detail off screen. It's like M&A. Every CEO worth of salt's going to talk about M&A because it gets people excited and they pumps the stock up a little bit in the hope of something. And I said, well, you've done the kind of Alta Mesa deal there, 30% of that, great. Bit of foothold into the North American market, great, but not really a big transaction. You've got a lot of money. Why don't you go and buy one of these developer companies? They're desperate for the money. He said, we've looked and we've been in data rooms and we have done the rounds. It's like there's nothing there of the quality and scale that we're going to need to be able to kind of make a difference to us. That's not to say we'll make a difference to someone else, but to them, it didn't move the needle. And I have these conversations with you. I have lots of CEOs I respect, and you, and that came out wrong. It just came out wrong. And where we just go. We know which assets are good quality assets. We know which projects are more likely to work than others. I'm talking about developers here specifically because exploration is always some chance that you could find something big. And it's not a lot of quality around at the moment. And that's a real problem for the industry as a whole. Again, specific to uranium, but I could say the same thing about all the other metals at the moment. It's not everything because it's public means it's good. Certainly not the management team, certainly not the assets, certainly not the ability to access capital to actually maybe create some value. And maybe for some of those guys, it might be a question of timing, it might be a question of decision making, might be a question of what the exchange is doing, or quite frankly, what it feels like now is retail are definitely not being contrarian. They're being terrified by what the heck is going on in the marketplace. So it's probably actually a lot easier than people realize if you stop and think and actually ask the right questions and focus on some of the things we've just talked about there. But I think that's a kind of generic phrase where people just good management team. These are good management team. What have they? This is a good management team. Really? What have they done before? Have they built a company, created value for shareholders, and made you money or anyone else money ever before? If the answer is no, maybe you don't want to go running towards that one. Maybe do a little bit more work because maybe the asset can help do some of the heavy lifting there. And even if the asset is good enough, are these the guys to actually do that for you? So I think there's more, as I always say, there's more deals looking for more money than exists. So don't worry about missing out on this one. There'll be a better one coming along soon. That's my attitude to contrarian investing anyway.
Yeah, no, I don't disagree. It shouldn't be that hard, and you don't have to look too deep. And now, we're looking at it every day, so maybe it's a little easier for us to go, gee, that was kind of obvious. You should have seen that coming.
This is true. This is true. It's a fair point. And that comes back to our, where we're at the beginning of this, which was like, what should retail really be spending time doing? So there's a lot of doing things that they should be, that we laid out here, but it's easier to do if you've got lots of spare time. But if you've got a day job and you're working 10 hours a day and you're traveling an hour to work and an hour and back and you're getting home exhausted, maybe not so easy. Maybe not so easy in terms of it's like going to the gym. I kind of know I should, but I'm too tired. So yeah, maybe
Rick Rule had an interesting metric around that as well, and he said because he looked at everybody's portfolios and he says if you're holding speculative investments, you should not hold any more than you are able to spend an hour a month researching.
Yeah.
Don't have 50 of these things because you're not spending 50 hours a month on this stuff. And if you're not spending that hour, you're just going to lose your money.
It's called spread betting. Yes.
Well, yeah. That don't work. So, and that's really the case. If you haven't got the time to look into, and that hour can't be spent, trolling Reddit and, Twitter.
Listening to idiots. Yeah, who've got no experience but long on opinion, or very angry about something, or trying to do the greater fool theory with you, get you in so they can get out. Mm-hmm. That's not research, and I think that's the big problem here. Is like people having the training and, quite frankly, the intellect, the time, the analysis capability, the understanding, the list goes on. There's a lot of things that you need to be to do research. Sitting in front of a screen is not enough. It's like, what are you reading? What are you understanding? What are you doing as a result of that? That's so important here. And that's what I really rail against these kind of enthusiastic newsletter writers when we do our analysis on analystnotes.com, these are guys who've built mines, right? They've operated mines, they've made discoveries, they've, and then advance it through the development phases. Those are the guys who write our reports. So they're clearly in industry. So it's a bit easier for them to kind of spot what rubbish looks like. If you're not in the sector, it's going to be a lot harder. And I think that's our fault, the sector's fault, because we should be able to make it easier. But what we've been very good at doing is destroying value by being full of shit, not being held accountable by the exchange enough, not being held accountable by, I guess, the sector as a whole. People should be called out. But when I read some of the stuff I see on CEO or Reddit, etc., I'm like, oh my dear God. It's like, and it's not even worth getting into an argument, because there's only one thing that's going to happen. When you're arguing with stupid, you're going to get stupider. That's it. So it's a bit irritating. Just
yeah, well, that's it. And we've seen it. You've seen it in the movement of the equities. You've seen it in that you can see where people are herding in at the wrong time, and then abandoning ship, too late. While the funds and a lot of the other smarter folks are actually, you can see them getting in and out at the right times because they're watching it that closely. So, I mean, if you're being swayed by somebody screaming at you through a screen to get in, it's probably way too late. You missed it. So you need to go back to basics. And as I say, you need to know where you think the cycle is, if it's a cycle, and it usually is, and you need to determine how you want to play it. You could have just simply bought Cameco a few years ago and ridden that. There you go. Then you don't have to think about it. And it went from $15 to, it went from 50 down to 15 and then back up again. But, or if you're going to get more granular, you spend a little more time looking for that. If you want the 100 bagger, if you want the NexGen or whatever, you have to then dig a little deeper and find the right vehicles to put your money down on.
Right. Sounds like. Look, I mean, the other thing, and we touched upon it, but I just want to be sort of quite clear, because you sort of talked about maybe jumping on the curve when it's sort of halfway up, and then trying to find an exit. I mean, it's finding an exit. So kind of real. Wow, Christ! Depends who you're talking to. They'll tell you how skillful they are, but I don't know anyone who's been able to time an exit other than through sheer luck. And if they tell you otherwise, they're full of shit, because it's
the hardest part. It's the
hardest part.
Buying a stock is easy.
Yeah, yeah, but it's
selling a stock is really hard.
And it's fine to kind of exit on the way up, and you may miss the last 20%, and it's fine to exit, very quickly, after it starts a decline, and then miss the next tick up. Whatever you're comfortable with. You've got to understand your risk profile of your investing strategy and your appetite for it. But I think what you must do is have a strategy. Go, what would I be happy with? And then don't kick yourself because you missed a 5-bagger, instead you got an 80% gain. 80% gain is freaking extraordinary. Almost 2 times your money. Fantastic. Don't worry about it. And they will come along every now and again. But what you probably won't forget, and you certainly won't talk about, is when you've lost 80% of your money. So set out when you're going to exit, and don't change your mind. If the data changes, you can maybe reset, but don't make stuff up to justify holding on for a little bit longer. Well, even the worst thing is when this thing is a dog, you're resetting. Is it? Oh, I won't exit yet, and you ride this thing all the way down because you don't want to, realize that loss. You don't want to admit you got it wrong. You don't.
Or worse, or worse, you start buying more.
Worse.
Yeah, and I've seen it. I saw it during the last cycle when we were coming back up. So I mean, in 2007, that's when we hit the down curve on that cycle, and then the banks all blew up, and a couple of years later, 2010, we saw it all coming back again, and rode it up, and then of course Fukushima hit and took the market out by. I know people that were heavily invested in uranium on the way up, and for the following month, while the price of uranium went from whatever $70 back down to $20, we're buying like everything. They were buying. They kept doubling down, and lost it all. You got to understand your exit. People will not plan their exit. Like you're right. One is enough is enough. So if I'm in a speculative stock and I want to make 5 times, then that's fine. Set that goal, set that line. But when you hit it, for the love of God, get out. Don't wait for it all to roll back onto you. So you want to be selling into strength first of all.
Yeah.
You don't need to hit the apex of this thing. You want to sell into strength. When you see the euphoria really building, that's probably a good time that you're getting close to the end of days, because it's being elevated by things that don't make a lot of sense. That's when you need to start watching it. And you do need to watch in our case, you need to watch the contracting and what the utilities are doing, because they will tell a big story as well.
You're right. That is worth. Keep buying on the way down but there's someone come. I always say that's a kind of tax on stupid, but there are then, of course, there will be. This is what's so confusing when I see so adorable about this space. There'll always be someone who says, "Well, I kept buying all the way down, and then a year later we're 4 times the price because it's came back. Some miracle happened, some divine intervention happened." And there's always a story like that, which is the nightmare in this space, because there's always some justification of what could be. It's like you're an addict at this point. No rationale will have any effect on you. It's like, no, but there's this example in Australia where this happened. Like, okay, but as a percentage, that's a very low number of companies that have been able to do that.
Doesn't. But in this case, I mean, we are now looking at a market. I mean, again, if you want to believe where we are in the cycle, where now the spot has gone well below the term, and so now it's oversold, and the equities are all oversold. Certainly, in amongst those equities, if you spend a little time looking, you're going to find some things that you see that are undervalued right now, that have taken a bigger hit than that are probably the better ones to get on and ride back up again, because in the wake of term prices squeezing up and up and up very consistently, quite frankly, and smoothly. We see the equities in the spot market doing this. So, quit buying high and selling low, for crying out loud. Turn it around.
Hey, right. Okay. Well, look, we've been rambling long enough, and I've got to shoot off somewhere. It's family day. It's also family day here. It's half term, which means the kids are back from school. So I've got to do things like
I've locked them out of the room, so they want back in now.
That's a good
probably
thing.
More snow to shovel.
I've got to go and do like museums and educational things like that none of us actually want to be at, but we've got to pretend we're good parents. So we will take them to a few museums and down in London. So I better go and do things like that. How are you guys getting on? I saw you sort of put out some. Talk about some targeting and preparing.
We're getting into our busy season, and we said we were going to see this happening now that we've got, we've got a lot of projects, we've got a lot of different people helping to fund them, and we're moving steadily through the year. We're going to be drilling at our joint venture with Cameco, start that up in a couple of weeks. We've got our one of our joint ventures with ISO. We're going to be starting that drilling in the spring. We're going to be and doing that through most of the summer. We're hitting actually a number now that we've been able to reconcile and kind of correlate all of our various data, geophysical data and historic drill data. It's quite interesting. It's given us a bunch of places that we're going to hit. So we're going to be actually hitting 6 or 7 discrete areas in amongst that project. And then one of our other projects that we've joint ventured with ISO will be drilling in the fall. So it's like a lot of consistency. We're now well into drilling.
So what's the drill budget for the year for you guys? You got a sense of that?
With ISO, it's $5 million.
Yeah.
On those 2 projects, and with Cameco right now, it's about $1.5 million.
Mm-hmm.
And then we'll be doing. We're not going to be drilling some of our 100% owned projects this year, but we're doing some other work to get them ready to go as well. So
right.
That's what we're up to this year.
It's interesting to see the Camecos and the Oranos, focusing back in on some of these sort of exploration type projects, because it's kind of been a little bit back burner for the last 5-6 years.
Yeah, no, it's they're spending money in ways that they haven't. I know over on the west side, I know Orano's got 3 other programs going on outside of ours. Yeah. On the exploration side, and Cameco as well has got a lot of work going on. So, yeah, things are lighting up again, and we're taking advantage of all the work that's been done to date, and we're anxious to make the next big one.
Good man. Chris, I'll see you for one last episode next week before I see you in Toronto land.
That's right.
Where I'm looking forward to the Monday night uranium get together, the Hogmanay of uranium, and it'll be a big one.
The hottest ticket in town, man.
Yep. Okay. See you next week.
We'll see you then.